Futures are down and world market arrows have turned red. Also, jobless claims and consumer index figures come in today. Will the recent rally get a well-deserved breather? I'm Brittany Umar, and the morning call starts right now.
Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Brittany Umar, and together we bring you Morning Call. So futures are off a bit this morning as overseas markets had a slight pullback after that 5-day run we saw. And so now I guess we'll have to see if we get that breather that everybody's been waiting for.
I think everyone's taking a deep breath, waiting for a breather. And after 5 up days since last Friday's jobs report, after a world market rally like we've seen over the course of the past week, let alone the past few months, a day off is nice. I think everyone wants a few days off, but the market hasn't been giving us anything much more than, a slight pullback.
Right, and of course, closing at all-time highs again yesterday. Why don't you show us the levels you're watching?
Well, if you look at the chart of the spiders, we've been talking about the spiders, even though you have Dow at 15,000, you have S&P at 1,600. The reason why the spiders is just because I like to gauge this last part of this move from the gap. This is the gap that we saw on Friday. I was like, okay, we gapped up Friday. It wasn't an exhaustion gap where we gapped up huge and closed down. It was just a gap up and we held. So I said, how much of this, gap can we hold? And we didn't even attempt to get into it. And then from there, this has been this week. A little bit higher, higher, higher into yesterday's close. So with that being said, a slight pullback would be nice. I think if we push through yesterday's high of 163.69, maybe we extend and then perhaps get some kind of doji or some kind of topping tail. But for right now, the trend has been very strong, starting from this reversal here in November, to when we tested it here going into the new year. And then, the last time we had a pullback of anything substantial, we held the 50-day. And this was the only time we've held the 50-day, or touched the 50-day, in all of 2013. So overall, technically, it's been a very, very tradable, strong rally where the only reason to doubt it is if you read the headlines and you follow mega bears out there, because technically, it's been a lot to like and not a lot to, dislike.
Well, so being, as you say, there's a lot to like and it has been tradable in an overbought market per se, how are you handling it?
Well, it's interesting because we extended higher yesterday, and I think I'm coming in with more longs today with shorts, with a short than I had yesterday. But here's the thing, when you're in an overbought market, you could stay overbought for a long time. And as long as you're doing a trade for a reason, and if that reason is still valid, it doesn't matter where the market is. So for me, I'm looking for a few, 2013 new high trades. I'm also trading some laggards that had, a day one of upside on decent volume. That anytime there's a day one, sometimes you get a day 2 or day 3. I'm also in the spiders. I have more spiders on short than I had yesterday just because of where we are, and I actually put them on yesterday late in the afternoon. That hurt a bit. So at this point, every long that I have is for a reason. And as we extend higher, maybe I just do it with less size, and I'm a little bit more, quick on the gun, so to speak, where I have 1 foot in the door, 1 foot out the door. I'm leaning out the door versus, in.
Well, one type of trade I wonder if you're really keeping an eye out for are stocks that missed earnings and plunged on earnings, but have done a great job in pairing losses.
Well, that in a strong market, that's typically what's been happening, because you're finding so little opportunities that, stocks that have gapped down on earnings, that consolidate lower for a few days instead of continuing to the downside, they've been bought up. And there are some opportunities there that I think we could take a look at. Right,
a stock like GE, which has had a nice comeback and already filled its gap from earnings.
Yeah, well, if you look at the chart here, GE, stock, I remember when we got involved in this earlier in the year, this nice wedge pattern. I think that was 2 quarters ago in earnings. We had an option play. Then I got involved in the stock, and it wound up building a nice upper channel, and then its earnings weren't great. So it gapped down through the 200-day, but look at my 200-day rule, guys. Remember, if it doesn't stay below the 200-day for more than 2, 3, or maybe even 4 sessions, that it's usually a seller's trap, and they take your stock and then it goes higher. Well, it regrouped and got right above it here, so this could have been your long. And then your next entry is typically when it gets in that gap. And then once you fill that gap, it negates the power. So at this point, when there are stocks in the financials, like whether it's Bank of America or whether it's Citigroup or Wells Fargo that are making new highs, and you have industrials that are also strong, everyone's like, okay, maybe we just buy GE. It looks cheap. It's got a dividend, 23. It's still not at high, so it's not extended like the rest of the market. So I am in long a little GE, and I think overall, with a bit more time, this bigger wedge could build. And then at some particular point in 2013, it clears this and could get to 25 to 27. But so far, it's been a decent cash flow trade off those lows.
Yeah, there are several stocks out there that are like this. I mean, IBM saw a big plunge on earnings on April 19th, but was able to bounce and reclaim most of its key moving averages. So do you think it looks like it'll be able to fill the earnings gap?
It's trying. And, this one also, like 2 quarters ago, it was great earnings, gapped up and couldn't hold the gap. This time, earnings were a bit soft. Gapped lower, looked pretty bad, and then all of a sudden, what does it do? Like a lot of companies have been doing, it increased their dividend, increased their buyback, and that's what people want and are thirsting for in this market. You combine that with the gap, and you go tactically here. You look at IBM. Here was your gap lower into support. Jill, I'll tell you, she was on the show right around here saying, "I love it, love it, love it." I was like, "All right, let's see what happens." And P.S. This is when traders liked it when it got into this gap because look at the size of it. You had a quick push up, it's trying to hold again, and at this point I would just keep it tactically. If you're a trader, it gets above this area, gets above 205.32, perhaps you get more upside. As an investor, maybe go more to the weekly chart so you're not involved in the noise. And I'd say as long as IBM continues to hold this support, and go sideways in this upper channel, have nothing to worry about. It's just digesting what's been a huge move for it over the course of the past few years. So it all depends on your time frame, but people are thirsting for big name, something with the yield, and they're buying their stocks, so investors feel a bit comfortable.
Now, how about eBay? Finally got a push yesterday and entered the earnings gap, closed on highs. So could we potentially see it fill the gap today?
Yeah, it's almost there, and I was looking at it like 5 times yesterday. I'm like, what, eBay missed, but still, people love it and they go back after it, and every time eBay looks horrendous, it's been more buyable than sellable. And you look here at eBay, after its earnings, it also had a gap down, had a little bit of follow through to the downside, never even made it to the 200-day, went sideways, and instead of creating a bear flag to continue to the downside, it actually wound up going to the upside because people need something to do. So here was that move, held higher and then closed strong yesterday. So with the futures down a little bit, I would say if it gets above yesterday's high, you could see more continuation to the 56 level. And then at some point, you go back to your weekly chart, same thing as IBM. This has had a really big move, all the way up to the highs. It broke this trend right here. It's trying to rebuild. So I would say this too, as long as it stays above, your macro moving averages, and you're in it and you're just sitting in it for multi-years, it still looks good.
And Procter & Gamble, we know that one dropped nearly 7% after missing earnings on April 24th, but finally got that push yesterday, was able to close above its last key moving average. So do you think we'll finally see it continue to climb? I mean, this is a strong consumer name a lot of people like out there.
Right, and then how easily we all forget. We just forget for some reason. Oh, who cares what happened that quarter? I need something to do. This has a yield. This was a favorite. Everyone wants to buy a dip. So even these companies on some, I guess, bad news that doesn't last too long. And you look here in PG, no one really was expecting this type of move down after earnings. It was just, clear sailing, so to speak. It was on its way up, closing the highs. It's P&G, can't do any wrong, and then pow. So what's happened since? Not much downside. This was your earnings, gap move to the downside. Tiny bit of continuation, and then did nothing. So now here it is, coming back into this little downtrend. Here's your gap. So everyone's looking to place money somewhere. So at this point for a trader, if it gets above 78.51, next spot would be to try and fill this gap. And most of these stocks that have this type of quality are all filling them. So keep it on the radar.
All right, coming up, we're going to go in the trenches with stocks holding above their earnings gap. But first, a quick commercial break. Stay with us.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
We're back and going in the trenches with stocks holding above their earnings gaps. We know casino stocks are acting well during this rally. MGM, one of Scott's favorites. This has actually been upgraded and is opening at 2013 highs today.
Yeah, I think it was upgraded by Stern Agee, if I said that correctly. Sorry to them if I didn't. You know, this stock for the last 2 years has been somewhat of a vehicle that an animal. It hasn't been an animal. At times it's an animal, but you know, it's been a vehicle that I've been going to. You know, since like 2 years ago it was $8, and every which way it's had some tradable setups. The last setup that we saw in MGM was this sideways consolidation. Nice, you know, 3-4 month consolidation channel, so to speak. And once it broke above this 1310. You know, it gave you another nice move. I think I was involved in the calls for this. I didn't have the stock. And then, boom, continued. There was your earnings gap. Didn't have enough juice to just get up and go because of the size of the move prior. Now it's digesting above it. Let the 8-day catch up. Got upgraded today. Now we'll see how it handles this 15. If it could hold above 15, you'll probably see a price extension. If it can't hold the gap up, that means it needs more time. But overall, you go to the weekly chart on MGM, which everyone knows I love longer-term channels, and this one seems like, to me, it's going to, you know, really get up and go at some point, whether it's this year or next year. You know, the 200 days right around here. You know, I think that this stock within, you know, it'd be really frisky to get there this year, but at some point this stock will be 20 to 22 over the next maybe 1 to 3 years. So you want to put it in the drawer and forget about it. I think, you know, MGM has that kind of capabilities. Look where it was and look where it is right here. And that's, you know, not too much to ask for in my, you know, humble opinion.
I agree. Well, another casino, WYNN, has been able to gap up on strong, was able to gap up on strong earnings and has been able to rally, grinding above its 8-day. Does it look like anything is standing in its way at this point?
You know, this one, it's been kind of more erratic the past year. It was the leader of the entire group for multi-years. You know, that run that we had from the lows all the way up until last year, it was very methodical. WYNN always led the way. LVS was a close second. MGM was the, you know, the tail of the dog, so to speak. And now, you know, WYNN has stepped up to get some of its leadership back. You look at the chart here and you will see, you know, it's trying to clear this prior pivot here, which was back in May of last year. You did have a nice move to start the year when it went above this 129-ish area, and then here you are consolidating higher. Yesterday we talked in retail on, you know, some of these consolidation 2013 extension plays. They're not the easiest to come by, and you need a very strong market to have it, but you know, I do think that some of them are having some success breaking above it. So for WYNN, you know, if it can get above 140.30 with some authority, I do think that it can continue higher and we should see higher prices this year. So this one, you know, still looks good in my opinion.
Now, speaking of retail, Nike had been lagging in the first quarter, but was able to gap up on earnings and gained 12 points after the earnings gap. So do you think this one still has room to run?
Well, this one is a good example of the actual gap up earnings strategy, because if you look here at Nike, you will see that, you know, it wasn't really doing much, and then you had that gap up after earnings. And what did it do? It held the gap. It you know, trapped shorts. It didn't let buyers buy it cheaper. And then what happened here? Once it triggered above this pattern here, it then went in motion for a really nice move. So if you're a trader and you don't like to be involved for earnings because sometimes, you know, they don't go the way you expected, doesn't always happen, you know, you wait for this type of strategy. Here is your ignition, and there it goes. And you know, now it looks like it's flagging again. It keeps letting the 8-day catch up. So I would say as long as this continues to hold the 8-day moving average, if you're a short-term trader, stay with it. If it breaks this, you know, bigger support comes down here for the more intermediate guy at the 21-day.
And while we're in retail, Coach, better than expected earnings in April, been trending higher ever since. So where's next resistance there?
This is another good example because it shows you how this was a laggard play, needed a catalyst, needed to have something ignite a new direction. And if you look at Coach here, that was in the doghouse, you know, down here looking horrendous considering all of, you know, retail out there, or a lot of it, you know, was at highs. And look at the highs here of last year in Coach, and look at this gap down. So down here, no one was really expecting much. This is almost an island reversal to the upside where you have a gap down, go sideways, gap up. So all these people are trapped here. Anyway, with that said, you know, if you were looking for a strategy and you weren't expecting Coach to be good, you wait to see how this gap up is treated. And this gap up was treated very favorably. It opened up, couldn't get into it, held above it, you know, then went again, held higher. So now I think with Coach, if you're looking for a trade, at some point above 58.96, you can get continuation, and then the next big resistance comes in, closer to the 60-62 level.
And what about Regeneron Pharmaceuticals? Gapped up after its reported as well and has been able to hold above the earnings gap too.
This has just been a huge mover. We've talked about this group many times in the last 2-3 months, and it is tricky because it's very data driven, and you have to know when the FDA is going to come out with some type of approval, and you have to know what these clinical studies mean. So, but for me, who's not that smart, I just look at price patterns. And so you look here on REGN, this was a very strong one. You had a breakout from this multi-month channel way back here, put it on the map, it continued, then look at this, it consolidated. And just to show you, this is the type of trades you get in this type of market. After a move, goes sideways, lets the 8-day catch up, gets tight, and then expands. And this one, boy, did it expand above 220. Big move, then continued, and now you have this bull flag here, still a lot of shorts trapped. Some saying this should be north of 300. I don't know. All I know is that if it gets above 265-ish, it can continue. Now, I wouldn't do the same type of size here that you might have done here, considering that it is higher and it might be harder to sustain, but something to stay with when you need something to do in this market in May.
Come on, Red Dog. You're a smart guy. What are you talking about?
I'm all right.
All right, let's do some quick hits here and talk Apple, which went ex-dividend today, could see some pressure. How do you think it'll affect the stock?
Well, it's funny because all the shorts out there in Apple, it's funny how everyone tried to find the bottom, and now everyone's trying to say, okay, we've just rallied too much and it's nowhere yet still. Are saying that now that the dividend is out of the way and it went ex-dividend, that some of the buy pressure will be off the stock, which it makes sense a little bit. If you were buying it for the dividend, you had your last day to get in there. That was yesterday. So it's pre-adjusted for the dividend today. Maybe you have some less demand for the stock from people who wanted it just for the dividend. But I think most people for Apple look for some type of motion, price pattern, appreciation. So anyway, you look at the chart here and you will see that ever since it reclaimed this 419, 420 area, it's moved up pretty well, pretty methodically. So now here it's consolidating again. It is off a little bit today. I do not own it. I was a swing trade buyer here, and then I think I sold it right around this area or something like that. Anyway, the longer it holds in this sideways area above this moving average, the more bullish I will get for a short-term tactical play. All right. I think maybe I nibble somewhere around this 454-ish, and then if it starts to go green again, I think you get your momentum play if it can get above and stay above 465 to 466. Because the way this is going, it does seem as if it's going to want to test a 200-day at some point this summer at 512. So I still think there's room there, and even at 512, it might look like a huge move from the earnings bottom, but to be honest, look where it came from. It came from 700 down to here. At this point, if it does turn lower, people will be like, oh, look, Red Dog, double top, Apple's cooked again. We'll see how it happens. That's why I'm saying it should, not breach or close below this 451 to 454 if you're going to see some commitment up here for guys like me to get excited to add to it on strength.
All right, interesting to see what it does at that level. Now, Facebook, we're hearing reports that it's getting ready for another acquisition. Do you think we'll find some opportunity there?
Looks like they're starving for revenue and starving for mobile expansion. Some people think this is good, some people think it's bad. All I know is that Facebook's been very tricky. Beginning of the year, really quick move. Now after earnings, it's been having some faulty action. I did buy a little bit yesterday on this small reversal here. I did have a call spread into earnings, and I managed it pretty well up here. Since then, I haven't touched it because I thought it should not have broken back below 28 if it was going to be any good. Broke back below it. So if you kind of take this out of the way or take this line out of the way, I would just say, okay, let me, give this a small benefit of the doubt from just say where it is here at 28 to where it bottomed out, that this is pretty much 50% of a retracement. So I said, if we get some type of Red Dog reversal where it trades below 26.85, comes back above it, I'll get a little long. So I did, but my stop is right here. This thing breaks 26.65, goodbye Red Dog. If it holds in there, breaks above 27.30, maybe I add for some cash flow. So I have no conviction here right now. I'm just waiting to see what the market does with it.
All right. Caterpillar missed earnings on April 22nd and had put in a Red Dog reversal and has been in motion since. What resistance level are you watching?
I think it's kind of there. We reclaimed the 200-day. It's had its oversold bounce laggard play done. So now it needs to see if there's commitment to it. But this was, we put an educational piece about Caterpillar on how to buy a laggard play and why you could have. And if you look here at Caterpillar, I'll go over it real quickly. I know we're running out of time. But, this is when it reported earnings on this date. I think this was April 22nd. They weren't good. They were actually missed. But look what happened. It broke below this pivot. So it broke below 80.01, made a small low here of 79.49, came back above, and that is your red dog reversal on an event with volume. So you know what? Let's put some volume in real quick. Basic studies, go to your volume just to see what it did it on, and look at the volume here that it did it on. So boom, had a second day, and then what happened? Okay, if you missed that day, because some people did, you saw a commitment higher, okay, and then it broke this small downtrend to the upside and continued. So here you are now, back at 90 after a nice move. If you got in on the red dog reversal, some people, treated it as a swing trade. If that was you, you got hopefully, you got rewarded for finding this type of tactical play in an overbought market, in a market that no one thinks can go any higher. Meanwhile, you did okay. P.S. We're now back into some bigger resistance, so it's going to be tougher. So I would not be buying Caterpillar right here. Let's see if it could hold above the 8-day for a little bit of time, and then see what happens next.
All right, new issue, Workday has been in an uptrend since its IPO. Is this one that we could buy on a pullback?
New issues are a little tricky, I'll say real quickly, because this is a quick hits above 66, maybe be a buyer.
All right, and the China group's been acting better, seeing some action there. SINA still holding above its gap from April 29th. Could this one be next for a breakout?
This group was somewhat left for dead, and then all of a sudden I look and I'm like, oh, look at this stock, look at SOHU. SOHU had a tremendous move into new highs. You look at BIDU, okay, this one, has gotten crushed, finally held support, went sideways, ignited a little bit right here. 3 big days, made it through some resistance. This, I think, gets to the 200-day. And then you have SINA, which has a big gap. We talk about gap when we talk about strategies there, off of whether it was the Alibaba stake or whatnot. All I know is big gap up. It could not fill it. Yes, it didn't gap and go that day, but look at the size of this, and now it's showing some commitment above it. You go sideways and take that tail out of the over emotion out of the trade, and I do think that above 58.35-ish, you could see a move well north, back to at least test that and higher. So we'll see how that goes.
And Basic Materials led the market yesterday. Cliffs Natural Resources had a really nice move. I know you guys were all over that one.
Yeah, well, again, something to do, some kind of tactic. With the China numbers getting a little bit better, people were looking for, heavily shorted stocks, some of the resources. This name, way back when you look at CLF, you'll see that this one was $100. I think, what was it, not even 2 years ago? Anyway, last summer it was around 50, so here, down here, with this type of pattern, I was like, you know what, it deserves a little opportunity. So it did break above a key level, above 22 on some volume. Close strong. I think it might be off 10-15 cents. I'm going to give it some space, but if it can get through 23.22, yesterday's high, I think next area is 25, and then no reason why it can't get back up to this 28-ish area, as people are looking for these type of patterns, and money did rotate in some of these resource type names.
All right, well, clearly you'll be looking for your spots today. We do have jobless claims out at 8:30, consumer index at 9:45. What will you be paying the most attention to?
A little bit of everything. If all of a sudden, the banks, I feel like, just had their move, so we got that could use a rest. Some other stocks, are like the retail, I thought could make new 2013 highs, or some of them yesterday they didn't. Spiders, 5th up day, maybe this is the first time it could pull off a little bit, so I leverage a little bit more into the spider short so I can make extra cash flow there. But overall, the real money's been made, targeting and rotating through different types of setups and sectors, and trying to buy the dip and trying to hold the portfolio approach. And until that truly changes, stick with it. Don't listen to the sell in May and go away. Don't listen to everyone out there saying, like I think Rubini was there yesterday saying, okay, I think the stock market can go up 2 more years, then we crash. Okay, so let's talk to him in 2 years from now,
right?
Versus him saying that and keeping everyone out of the market till then. The same way whatever we did from 700 S&P to 1474. That just irks me when you have people, whatever, that are influencers. There are influencers out there in the world, and at least be responsible about the language you use.
Right.
That's why I was so ticked off last summer when guys were like, "Oh, equities are dead." I'm not going to say who said that, but I'm like, equities are dead. You have stock making historic highs. You have a market trending up. Why scare the average investor out of the market by saying equities are dead? And then he rephrased it, I think, a few months ago and said the type of equity investing is dead. I'm like, okay, well, equities are dead is what the headline was. So anyway, I'm doing all these metaphors now, and bottom line is, treat this area differently than you treated it a week ago as far as the market. And just keep trying to be involved, make some money. Don't be all in, don't be all out, and have some quick feet, I guess.
All right. Well, happy trading, everyone. Have a great day.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.